$1.7 trillion erased in 90 minutes. Let that figure sink in for a moment. $1.7 trillion exceeds Spain's complete GDP. It surpasses Mexico's entire economic output, and it simply disappeared from the precious metals marketplace in a time frame shorter than a typical film. This morning saw gold trading at $5,100. Silver reached an unprecedented peak of $117.75. Within 90 minutes, gold plummeted to $5,000. Silver collapsed to $103. Gold fell 2%. Silver plunged 12%. And if you're currently watching this, questioning what transpired and whether panic is warranted, you need to continue until this video concludes, because the information I'm about to reveal fundamentally transformed my perspective on this crash. I'll present a 30-year chart that clarifies precisely why this collapse occurred and why it was genuinely foreseeable if you understood what to examine. And I'll demonstrate what transpired the previous time silver contacted this identical price threshold. Hint: it surged 462% following that event. But initially, let me illustrate what actually triggered $1.7 trillion to vanish in 90 minutes. I analyzed the financial developments that conventional media overlooks. Press the like button if this content aids your comprehension of recent events. Now let's begin. So here's what unfolded this morning that generated shockwaves across every trading floor globally. At roughly 9 a.m. Eastern Time, silver traded at $117.75 per ounce. This represented a completely new all-time peak, the highest valuation silver has ever achieved in documented history. Gold stood at $5,100, likewise approaching record territory. Everything appeared optimistic. Celebration was widespread. Then within 90 minutes, silver plummeted from $117 to $103, a $14 decline, 12% of its worth erased in under 2 hours. Gold descended from $5,100 to approximately $5,000, a $100 reduction of about 2%. Now, here's the intriguing element. Gold fell 2%, silver fell 12%. Identical market, identical time frame. Completely divergent responses. Why? That inquiry holds the key to comprehending everything I'm going to explain. Before I clarify what generated this crash, I must teach you something that will fundamentally alter how you examine price charts. And I guarantee to make this sufficiently simple that even if you've never studied a chart previously, you'll grasp it by this section's conclusion. When traders examine charts, they seek two elements: support and resistance. Visualize it this way. Imagine you're bouncing a ball within a room. The floor represents support. Each time the ball contacts the floor, it rebounds upward. The ceiling represents resistance. Each time the ball contacts the ceiling, it rebounds downward. In markets, support constitutes a price threshold where buyers emerge. Each time the price descends to that threshold, people declare, "That's affordable, I'm purchasing." And the purchasing pressure elevates the price upward. Resistance is the inverse. It's a price threshold where sellers emerge. Each time the price ascends to that threshold, people declare, "That's overpriced, I'm selling." And the selling pressure forces the price downward. I'm presenting a 30-year chart now that astonished me when I identified the pattern. From 1996 to 2014, silver traded within what we term a descending channel. Envision two diagonal lines descending from left to right with the price oscillating between them like a ball bouncing between two barriers. Throughout this complete 18-year duration, there existed one line in the channel's center that functioned as a crucial threshold. We'll designate it the white line. In 2008, during the financial catastrophe, silver descended completely and contacted this white line. At that instant, silver traded at $8 per ounce. $8. Now observe what transpired next. After contacting that white line in 2008, silver didn't merely rebound. It went absolutely exponential from $8 in 2008. Silver surged completely to $45 in 2011. That's a 462% increase in roughly 2.5 years. The white line provided support. The ball contacted the floor and rebounded forcefully. Now, advance to today. From 2014 to 2026, silver has traded in a new ascending channel. Envision two diagonal lines ascending from left to right. And what occurred? Silver contacted that identical white line again. The precise same threshold that functioned as support back in 2008. But here's the essential distinction. In 2008, silver was descending and contacted the line from above. The line functioned as support, the floor. In 2026, silver was ascending and contacted the line from below. The line now functions as resistance, the ceiling. The floor transformed into the ceiling. And what occurs when a ball contacts a ceiling at high velocity? It rebounds downward forcefully. That's precisely what occurred this morning. Silver contacted a 30-year trend line that has characterized major turning points in the market for 3 decades. The rejection was intense because the threshold is significant. This wasn't random. This wasn't manipulation. This wasn't a black swan occurrence. This was a textbook technical response to a major multi-decade resistance threshold, and this explains why gold only descended 2%, while silver descended 12%. Gold didn't contact any major historical resistance threshold this morning. It simply got caught in the general precious metals liquidation. But silver contacted the line that's significant, the line that has characterized this market for 30 years. Now you might be considering, okay, so silver contacted resistance and descended. Does that indicate the bull market has concluded? Should I liquidate everything? Not quite. Let me explain what occurred after silver contacted that white line in 2008. Remember, silver stood at $8 when it contacted the line in 2008. Over the subsequent 2 and 1 to 2 years, it reached $45, a 462% increase. But here's what most people overlook. Silver didn't advance straight from 8 to 45 in a smooth trajectory. There were crashes throughout. Intense ones, 30% declines, 40% declines, shakeouts that convinced people the bull market had concluded. But the overall trajectory was upward. And you know something else? In 2011, silver ultimately broke through that white line resistance and advanced even higher. So here's the crucial inquiry. Is this crash the conclusion of the silver bull market, or is this merely a normal correction within a larger uptrend, a shakeout before the subsequent leg higher? Let me present the evidence on both perspectives, and then you can determine for yourself. Now, I must explain the second reason silver crashed 12% while gold only descended 2%, because this component is essential. The CME Group, which operates the COMEX exchange, where most gold and silver futures trade, just executed something that has historically indicated major turning points in the precious metals market. They elevated margin requirements. Let me explain what that signifies in the simplest possible language. When you trade futures, you don't need to provide the complete value of what you're purchasing. You provide a small percentage termed margin as collateral. It's like a down payment. If silver trades at $100 per ounce and a futures contract represents 5,000 ounces, that contract controls $500,000 worth of silver. But you don't require $500,000 to trade it. You might only require $20,000 in margin. That $20,000 controls $500,000. That's termed leverage. Now here's what transpires when the exchange elevates margin requirements. Suddenly that identical trade requires $25,000 instead of $20,000 or $30,000 or $32,500, which is precisely what CME executed last week. They elevated silver margins by 47%, from approximately $22,000 to $30,500 per contract. If you're a trader who's completely leveraged, you now face a problem. You must either contribute more cash to your account immediately, or you must close some of your positions. Most traders cannot contribute cash on short notice, so they're compelled to sell. And when thousands of traders are compelled to sell simultaneously, what occurs to the price? It crashes. This is termed a liquidation cascade. Forced selling initiates. More forced selling as prices descend and more margin calls get initiated. The CME margin increase was the mechanical catalyst for today's crash. The 30-year resistance line was the technical catalyst. Combine them together and you obtain a 12% crash in 90 minutes. Now here's the component that should make you very concerned if you're short silver, or very enthusiastic if you're seeking to purchase the dip. This is the precise same strategy that has been utilized at every major silver peak in modern history. In 1980, brothers named Nelson and William Hunt had accumulated substantial silver positions. Silver advanced from $6 to $50 in approximately a year. Then, the COMEX implemented something termed Silver Rule 7, which imposed heavy restrictions on margin purchasing. Silver crashed from $50 to $10 in a matter of weeks. The Hunt brothers declared bankruptcy in 2011. Silver advanced from $8 to nearly $50. Then the CME elevated margin requirements 5 times in 9 days. Silver crashed from 50 to below 30 in weeks. And now in 2026, silver advanced from approximately $30 to $117. CME elevated margins by 47%. Silver crashed 12% in 90 minutes. Same strategy, different decade. The inquiry is, what transpires next? Because here's the element that nobody is discussing. After the 1980 crash, silver entered a 20-year bear market. That crash was the conclusion. But after the 2011 crash, silver descended from 50 to below 15 over the subsequent years. However, the bull market ultimately resumed and silver is now trading above $100. So the 2011 crash wasn't the conclusion. It was a correction within a larger secular bull market. Which variety of crash is this one? Let me provide you the evidence and you can formulate your own determination. First, the bearish perspective. The reasons this crash might be the beginning of something worse. Silver has advanced 270% in 12 months. That's an extraordinary move by any measure. Parabolic moves like this frequently conclude badly. The gold-to-silver ratio has compressed substantially. When this ratio gets extended too far, it frequently snaps back intensely. Speculative positioning is at extreme thresholds. Everyone is on the identical side of the trade. That's typically when the trade reverses. Margin increases historically indicated peaks, 1980, 2011, now 2026. Now the bullish perspective, the reasons this crash might be a purchasing opportunity. The fundamental supply and demand situation has not altered at all. China still restricted silver exports on January 1st. That's still active, that still impacts 60 to 70% of global silver supply inventory, is still down 70% from its peak. The registered silver available for delivery has collapsed from 86 million ounces to 28 million ounces. That hasn't altered. Industrial demand is still surging. Solar panels require 200 million ounces per year and expanding. Electric vehicles require silver. AI data centers require silver. 5G infrastructure requires silver. None of that altered this morning. The structural supply deficit is still the worst in history. 5 consecutive years of demand surpassing supply. 820 million ounce cumulative shortage. None of that altered. Physical silver in Shanghai is still trading at a $6 to $9 premium over the paper price. If the bull market was genuinely concluded, that premium would collapse. It hasn't. And here's the most significant point. In 2008, when silver contacted that white line at $8, the fundamentals weren't this robust. There was no China export prohibition, there was no solar panel expansion, there was no EV revolution, there was no AI infrastructure development. The fundamentals today are arguably the strongest they have ever been in silver market history. Yet the technical configuration initiated a crash. This is the tension you must comprehend. Technical factors can generate short-term crashes even when fundamentals are indicating bullish. The inquiry is whether the technicals will ultimately submit to the fundamentals or whether the fundamentals will submit to the technicals. Historically, fundamentals prevail over the long term, but technicals can generate tremendous pain in the short term. Now let me inform you something that occurred in the physical market today that almost nobody is reporting. While the paper price crashed 12%, what transpired to physical silver premiums? They actually elevated. Dealers weren't reducing their prices by 12%. They were barely reducing them at all. Some actually elevated premiums because demand increased as bargain hunters attempted to purchase the dip. This is the identical dynamic we observed in the nickel market in 2022. The paper price of nickel traded at $20,000. Then physical supply became constrained. The paper price surged to over $100,000 in a matter of days because the paper market had to synchronize with physical reality. Could the identical thing transpire in silver? Nobody knows with certainty. But the divergence between paper prices and physical premiums is a warning indication that this market isn't functioning normally. There are 356 paper claims for every 1 ounce of physical silver in COMEX vaults. That's not an error. 356 to 1. That's like an airline selling 356 tickets for every seat on the aircraft. At some point, that mathematics fractures. Let me provide you some perspective on what we just observed. Silver descending 12% in 90 minutes is one of the largest intraday movements in silver market history. The previous time silver moved this intensely was in September 2020. Before that, you must return to March 2020 during the COVID crash. Before that, 2011. These varieties of movements only transpire a few times per decade. And here's the pattern I want you to recognize. Every single time silver has experienced a crash like this in the past 15 years, it has ultimately recovered and established new peaks. September 2020 crash, recovered, established new peaks. March 2020, COVID crash, recovered, established new peaks. 2011 crash required years, but ultimately recovered, and now trading at all-time peaks. The crashes feel like the conclusion of the world when they're occurring, but examining retrospectively, they were just corrections within a larger bull market. Will this occasion be different? Perhaps, but history indicates probably not. Now, I must be very explicit about something significant. I'm not a financial advisor. This content is not financial advice. Silver is extremely volatile. As we just observed, prices can absolutely descend lower from here. If you're leveraged in silver, you must comprehend that margin increases can eliminate you. Even if you're correct about the long-term direction, being correct doesn't matter if you get liquidated before the trade succeeds. If you're contemplating purchasing this dip, you must comprehend that catching a falling knife can be painful. The price could descend lower before it ascends higher. Conduct your own research. Comprehend your own risk tolerance. Formulate your own determinations. What I'm stating is that based on my analysis, this crash was a technical occurrence initiated by contacting 30-year resistance combined with a mechanical occurrence initiated by margin increases. The fundamental situation hasn't altered. China still restricts exports. Supply deficits still persist. Industrial demand still expands. Physical premiums still exist. Those facts matter. Now let me explain what I'm personally monitoring to determine whether this is a purchasing opportunity or the initiation of something worse. First, I'm monitoring the $100 threshold. If silver can maintain above $100 and consolidate, that would be extremely bullish. It would indicate the crash was a healthy correction, not a trend reversal. As I record this content, silver has already rebounded from 103 back to approximately 109. That's a positive indication, but we must observe it maintain. Second, I'm monitoring physical premiums. If physical premiums collapse, that would be bearish. It would indicate real demand is diminishing. So far, premiums are maintaining or even elevating. Bullish. Third, I'm monitoring COMEX inventory. If inventory starts ascending, that would be bearish. It would indicate the supply squeeze is diminishing. So far, inventory continues to drain. Bullish. Fourth, I'm monitoring China. If China reverses its export restrictions, that would be bearish. So far, no indications of that. Bullish. Fifth, I'm monitoring the CME. If they elevate margins again, that would be bearish. More forced liquidation approaching. We must monitor their announcements. As of right now, 4 out of 5 indicators are bullish. Only the margin increase concern is negative. But that doesn't indicate the pain has concluded. Markets can remain irrational longer than you can remain solvent. Be cautious. Let me leave you with some historical perspective that I think is incredibly significant. In 1980, when silver crashed from $50 to $10, everybody declared precious metals were finished. The bull market had concluded. Gold and silver would never recover. 45 years later, gold is at $5,000. Silver is above $100. The people who declared it was concluded were spectacularly incorrect. It just required decades to materialize. In 2011, when silver crashed from 50 to below 15, everybody declared the identical thing. Precious metals are finished. The bull market has concluded. 15 years later, here we are at all-time peaks. The crash always feels like the conclusion when you're experiencing it. But zoom out and you observe it's just a correction within a much larger narrative. The larger narrative is this. Global debt is at all-time peaks. 38 trillion in the United States alone. That debt cannot be repaid in real terms. It can only be inflated away. Central banks are printing money at unprecedented rates. The Fed just announced $45 billion per month in reserve management purchases. That's $540 billion this year alone. Industrial demand for silver is structural and expanding. Solar, EVs, AI, 5G. These trends aren't disappearing. Supply is constrained and cannot respond quickly. 75% of silver originates as a byproduct of other mining. New mines require a decade to develop. These fundamental forces haven't altered because of a 12% price decline. If anything, they're becoming stronger. Now, I want to address directly 3 varieties of people who might be watching this content. The first variety is the person who panicked this morning and sold. You observed the crash. You observed your account descending. You experienced the fear and you sold. I'm not going to inform you that you formulated a mistake. Perhaps you did, perhaps you didn't. Only time will inform. But I will inform you this. Emotional determinations in volatile markets almost always feel correct in the moment and appear incorrect in hindsight. If you sold purely out of fear and not based on any analysis, you should contemplate carefully about why you formulated that determination. The second variety is the person who's contemplating purchasing this dip. You observe the crash as an opportunity. Lower prices indicate better entry points. I will inform you this. Purchasing dips in bull markets is historically profitable, but purchasing too early in a correction can be painful. Silver could consolidate here. It could descend further. Be patient. Scale in. Don't wager everything on one price threshold. The third variety is the person who has no position and is observing from the sidelines, questioning if now is the moment to participate. I will inform you this. The optimal time to purchase is when there's blood in the streets, when everyone is panicking, when the headlines are proclaiming crash. That's historically when the optimal opportunities emerge. But you require conviction based on research, not just gut feeling. Study the fundamentals, comprehend the technicals, formulate an informed determination. What's your situation? Drop it in the comments. I read every single one. Here's my final thought on this historic day. The crash was real. 12% in 90 minutes is intense and painful, but crashes don't transpire in bear markets. Crashes transpire when bull markets get overheated and require to reset. The fact that silver crashed from 117 indicates silver reached 117 in the first place. A year ago it was $30. The trend is still upward even if the day was downward. The margin increases are concerning. They have indicated peaks before, but they have also indicated temporary corrections before. We won't know which one this is for weeks or months. The 30-year resistance line is real. Silver contacted a significant technical threshold and got rejected. But silver has broken through major resistance thresholds before and gone exponential after. The fundamentals are unchanged. China restrictions, supply deficits, industrial demand, physical premiums, all still bullish. My conclusion is this. This crash was structural. It was foreseeable if you understood where to examine. It was generated by technical resistance plus mechanical liquidation. But structural crashes within bull markets are opportunities, not conclusions. I'm not selling. I'm not panicking. I'm monitoring. I'm waiting. And I'm preparing. Because if history repeats and silver breaks through that 30-year resistance threshold, the movement that follows could make the last 12 months appear like a warm-up. In 2008, silver contacted that line at $8, then it advanced to $45, a 462% increase. Today, silver contacted that line at 117. It withdrew to 103. Now it's back approximately 109. If silver ultimately breaks through that resistance, where does it advance? I'll let you execute that calculation. If this content helped you comprehend what transpired today, I read every comment and I want to know what you're contemplating. Share this with one person who was panicking this morning. They require to observe this analysis before they formulate an emotional determination they will regret. The crash arrived. The crash was intense, but the narrative isn't concluded, not even close. Stay sharp out there. Oh, and one more element before you depart. I want to address the elephant in the room that nobody is discussing. Some people in the comments are going to declare this crash was manipulation, that the big banks orchestrated this to eliminate retail investors, that the CME elevated margins specifically to protect short sellers who are about to get squeezed. Let me provide you my honest perspective on that. Is it possible? Yes. Is it provable? No. Here's what we know with certainty. JP Morgan was recently reported to have nearly $5 billion in unrealized losses on silver positions. They also reportedly transitioned from a substantial short position to owning roughly 750 million ounces of physical silver. The CME elevated margins by 47% right as silver approached major technical resistance. The timing is suspicious. I'll concede you that. But here's the element about markets. It doesn't actually matter whether this crash was manipulation or organic price action. The result is the identical. Prices descended. Leverage traders got liquidated, and now we must address the aftermath. Expending energy being angry about potential manipulation doesn't make you money. Comprehending the market structure and positioning accordingly does, so focus on what you can control. Your position size, your risk management, your entry and exit strategy. Let the conspiracy theories entertain you, but don't let them paralyze you. Now, let me provide you one final piece of data that I think is essential. Do you know what transpired to silver after every single CME margin increase in the last 50 years? In 1980, after the margin increases, silver crashed from 50 to 10. But then, over the subsequent few decades, it ultimately made it back to 50 and beyond. In 2011, after the margin increases, silver crashed from 50 to 15. But then, over the subsequent decade and a half, it made it to over 100. In every single instance, the margin increase generated short-term pain, but didn't conclude the long-term bull case. Why? Because margin increases address speculation, they don't address fundamentals. You can elevate margins all you want. You cannot print physical silver. You cannot generate industrial demand out of thin air. You cannot reverse China export restrictions with a margin increase. The margin increase is a speed bump, not a brick barrier. And once the forced liquidation has concluded, once the weak hands have been eliminated, what remains? Strong hands, patient capital, long-term holders who comprehend that volatility is the price of admission for outsized returns. If you made it this far in the content, you're probably one of those strong hands. You didn't panic. You didn't close the content at the first indication of bad news. You remained to comprehend the complete situation. That mentality will serve you well, not just in precious metals, but in everything. Markets are designed to transfer wealth from the impatient to the patient, from the emotional to the rational, from the leveraged to the unleveraged. Be on the correct side of that transfer. $1.7 trillion vanished today, but it didn't disappear. It transferred from one set of hands to another. Make sure you're the hands receiving, not the hands providing. That's the game. Now you know the rules. Play accordingly. Provide your valuable feedback in the comments if this helped. See you in the next one.